Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily and Equity Logic. These two companies are different, but they're based on the same premise. We like investment strategies that are capable of making money when the market increases and when the market declines. We are not one-sided, but instead we are proactive. And that is extremely important given where we are today. And I'm going to talk about that today. We're going to talk about the state of the economy. We're going to talk about the valuation levels of the stock market, the earnings prospects, the past earnings cycles as well. We're going to have a look at our current environment to determine what the risks might be. But most importantly, we're also going to talk about proactive investment strategies and the performance of proactive investment strategies. So I'll start with that question. The question to you: are your investments proactive? Can they make money if the market falls? Or are you dependent on market direction? That's the first question. The second question is logical. The second question is why? Why is it important to have a proactive investment strategy? Why can't you just buy and hold? We're going to have to talk about that. We're going to do that by identifying the risk factor. The probability of something happening and the consequence associated with that possibility identifies a risk factor that we need to observe. Some of the elements involved are liquidity, the reduction in liquidity as stimulus efforts are abated. Earnings, both past and future earnings, that matters because that helps us identify valuations that exist within the stock market today. And then, of course, the charts matter too. It does matter if we're involved in the stock market at a relative high or a relative low. We're going to take a look at all of the risk factors involved. For all of our clients, whether that be through Stock Traders Daily or Equity Logic, it all begins with awareness. If you are aware of the problems that exist, if you are aware of the valuation levels that exist, if you are aware of the earnings cycles that have taken place, you may be interested in managing risk. So that's our initial focus, awareness. However, awareness only takes you so far. If you are aware that problems exist, you need alternatives. We have those. We've been operating proactive investment strategies for a long time. However, performance of those strategies matters. So our secondary focus is performance, and we're going to talk about that as well. As we go through this, remember something critically important, and that is that you do have a choice. You don't need to do what traditional investment doctrine has dictated for the last 13 or 14 years. You do not need to buy and hold. You can manage your risk, and you do have a choice. Not only do you have a choice about being proactive and managing risk, but you also have another choice. You can empower yourself, or you can give us the authority to empower your competitive advantage for you. Through Equity Logic, we manage accounts proactively. Through Stock Traders Daily, we give you the tools yourself. So you have another choice you can make. You can do it yourself, or you can have us do it for you. Whichever you choose, please remember that you have an advantage. You have a distinct competitive advantage over the institutions that might otherwise manage your money. These behemoth, massive companies, these mutual fund companies, these 401k plans, they are not nimble. They are too big to be nimble, and they find it very difficult to manage risk as a result. But us, As individual investors, we can manage risk better than any of them could ever hope to. We have a competitive advantage. And during this presentation, one of my responsibilities is to help you empower that competitive advantage. I'll educate you on the situation at hand and give you those options so that you can then choose whether or not to engage them. We have a competitive advantage, and it's our responsibility to decide whether or not we want to take advantage of it. I'm going to start by talking about performance because, quite frankly, without performance, no one cares about proactive investment strategies. This is a proactive investment strategy called our swing trading strategy. This particular strategy has an exceptional return as that compares to the S&P 500. The orange line is the S&P 500. The blue line is the swing trading strategy. And the swing trading strategy began in October of 2008. Since then, the swing trading strategy is up about 104% versus the S&P 500, which is up about 77%. Roughly, the swing trading strategy is outperforming the S&P 500 by about, let's call it 40% over that given time frame. This is, by the way, one of the most aggressive upcycles in the history of the stock market. And this risk-controlled proactive strategy has beaten the performance of the market. It can also work when the market falls. That's the beauty of the strategy. It has significantly outperformed the market even during this upcycle. That is extremely important to recognize. Performance is there even during the upward sloping moves in the market. Here's another one. This one started in January of 2010. This is our lock and walk strategy. And its performance has also significantly beaten the S&P 500. The lock and walk strategy is up about 66% since January of 2010. The S&P 500 is up only about 44%. The outperformance is about 50%. For the lock and walk strategy, a strategy that can also make money if the market declines. This risk-controlled proactive strategy has also beaten the socks off the market during this bull run. The prior two performance graphs clearly show that risk-controlled proactive strategies can outperform when the market increases as well. But what they fail to show is what proactive strategies can do when the market comes under severe pressure. This graph does that. This strategy is our stock of the week strategy, and it began in December of 2007, right before the credit crisis hit. The significant outperformance of this strategy is only true because of the declines experienced by the market. But the outperformance is ridiculous. The stock of the week strategy is up 203% from December of 2007 versus S&P 500, which is up only about 13%. This is where the meat of proactive trading strategies comes from. Because they can make money when the falls as well, the outperformance versus the market can be tremendous. And the strategies we offer at Stock Traders Daily and through Equity Logic, the money manager, are capable of producing results when the market falls as well. Here are some raw data figures on that stock of the week strategy. The 1-year return is 21.1%, the 3-year return 62%, and the 5-year return 111%. The standard deviation 0.07. The beta, it's actually a negative 0.29, completely uncorrelated to the stock market. And the alpha is about 2. The power of proactive straight trading strategies could not be demonstrated better than in this raw data. The graph I showed before obviously demonstrates its ability to outperform. But proactive strategies that aren't reliant on the market to increase in order to perform have the ability to significantly outperform if the market comes under pressure. So although that pressure, those risks, are our primary focus in this presentation, I think they're secondary to actual performance. If you don't have performance, then it just doesn't matter. We have the performance. So now let's talk about why it matters. For clients of Stock Traders Daily, I issue special reports on a regular basis. One of the most important special reports that I issued identifies the real stimulus offered by the current $85 billion monthly stimulus program of the Federal Reserve. The conclusion was there was really only $6 billion worth of real stimulus. Given some changes that have happened over that time frame, this report was issued in June. The real stimulus looks like it might be more in line with $11 billion now, but the point is it is far less than the $85 billion face value, and that's because of the operations of the U.S. Treasury. There are more and more bonds being sold all the time, and so the trade-off is a stimulus program that is far less than face value. Now, I've also fair value analysis, some evaluations of earnings, of which we'll talk about. But my point is that liquidity levels are something that are being questioned right now. I don't expect tapering anytime soon. At least when I wrote this particular special report on tapering, I didn't expect tapering in September, and probably not through the end of 2013. However, it does appear that a reduction in this monthly stimulus program is going to come. That means that pressures on liquidity are going to come, and arguably the driving force behind the stock market has been the additional liquidity. However, the additional liquidity has been $85 billion. It has been far less than that. Therefore, although the FOMC does have more wiggle room, I do encourage you to read this special report, by the way. Although the FOMC does have more wiggle room, the bias is to reduce liquidity, and that's a red flag for the stock market. Next, an evaluation of earnings is necessary. This evaluation is available on StockTradersDaily.com for our clients. This is the second quarter 2013 Dow Jones Industrial Average results. The Dow Jones Industrial Average has a negative 3.69% EPS growth rate and a negative 1.77% revenue growth rate. The Dow Jones Industrial Average was contracting in the second quarter of 2013. But I don't think anybody is seeing that. I don't think they're paying attention. Because when we hear about beating estimates, those are analyst estimates. And although a company may do better than what the analysts thought, they may still be doing poorly. And that's exactly the case for the Dow Jones Industrial Average. In fact, this has been happening for a while. Here's the Q1 results. A meager 1.39 EPS growth rate with negative 2% revenue decline for the Dow Jones Industrial Average in Q1 of 2013. This has been happening for quite a while. And it's a big red flag. It's a red flag because the stock market has been increasing. The Dow Jones Industrial Average has actually been contracting, losing EPS and losing in revenue. But the market has been on fire. That's a red flag. Earnings are going one way, but the stock market has been going another. To be more specific, the stall in earnings began in about the second quarter of 2012. Since that time, almost exactly, the stock market has begun to accelerate. A material divergence exists now between earnings growth and stock market valuations. And that is largely induced by stimulus. The stock market has been increasing because more and more stimulus dollars have added liquidity to the system, which in turn increases the asset price. That is what drives the stock market, liquidity. Liquidity drives the stock market, so the more and more money out there, the higher and higher asset prices are likely to go. Not only the stock market, by the way, but also real estate, right? Other asset prices as well. The more money chasing the asset class, the higher in price that asset class is likely to go, regardless of relative valuations. And that is true until such time as the liquidity starts to dry up. And once it does, then valuations start to become important again. So what we're talking about here is a situation where liquidity is coming under fire. They are talking about reducing the stimulus program. They are making it quite clear that this is going to happen. In addition to that, earnings have been dismal, negative, very bad. But the stock market has been increasing in the face of those negative results. The stock market is now in bubble territory as a result. Even though the price earnings multiple of the market itself doesn't look horrible, when you compare that PE multiple to real growth rates, it looks awful. The stock market is extremely rich, and it is rich because it has been influenced higher by stimulus dollars that are now on the chopping block. Earnings and revenue do not match the increase in price of the Dow Jones Industrial Average, and that presents huge risks based on those valuation concerns. In addition, our macroeconomic analysis, which is called the investment rate, this is, by the way, in my opinion, the most accurate leading longer-term stock market and economic indicator ever developed, tells us that without liquidity, without more and more stimulus, not just a plateau of the stimulus efforts we have today, but without more and more stimulus, we are not likely to see new highs, and it's going to be extremely hard to grow, and in fact, much more likely to contract considerably. And to this I speak directly to the economy itself, but of course to the stock market as well, because the stock market is influenced by economic conditions. As of the end of 2012, The investment rate tells us that the natural rate of change in the demand for new investments in the U.S. economy declines precipitously and aggressively through 2015. This is a huge red flag, and it tells us that natural growth cycles are decelerating. And that is happening now in the face of a reduction in stimulus efforts. These should not go hand in hand. In fact, in order to sustain where we are today, more stimulus needs to be infused into the economy. But instead, they're talking about reducing stimulus in the face of a declining investment rate curve. I encourage you to read the investment rate to understand what it says. It is extremely powerful, and it defines where we are today. But clearly, the valuation levels that we talked about just moments ago and the divergence between the stock market and earnings, those matter more immediately as well. The investment rate is a longer-term cycle. It is a multi-year cycle. The average up periods in the investment rate are 26 years, and the average down periods are 11 years, and we are in the third major down period in U.S. history right now. And in the middle of this down period, they are talking about reducing stimulus, something they cannot do if they expect the stock market and the economy to hold its ground. Obviously, I could go into more detail, and I'm happy to do that. However, I think I've given you enough information for you to make an educated decision. The performance is there. The strategies exist. You have the ability to do it yourself, or you can have us do it for you. The risks are real. The valuations, they're sky high when you compare them to actual earnings growth. And the reduction in stimulus being debated by the FOMC at this time could bring the stock market to knees, because the only reason it is where it is today is because of those stimulus dollars. Sign up for a free trial. Understand what we do, and then explore additional options. Explore the option of doing it yourself or having somebody do it for you. But no matter what you do, understand the risks that exist in the economy. Understand that proactive trading strategies are something we have been doing longer than anybody else. And we can offer the same to you. But you have to make a conscious decision. You have to make the decision to investigate it. If you do, I am happy to share more explicit details with you. I'm also happy to help you find something that will work for you, given your specific, unique situation. Thank you very much.